Good afternoon, everyone. I hope you guys are having a wonderful day today. I'm delighted to welcome you all to our webinar on strategic insights into Canada's 2024 tax policy adjustments. My name is Ayushi Shah, and I'm the Director of Operations at NCS Canada. We specialize in outsourcing accounting services for Canadian CPAs and bookkeepers. It is wonderful to see such a great response for this event, and I thank each one of you for taking the time out today to join us. The Deputy Prime Minister and Finance Minister, Chrystia Freeland, delivered the 2024 federal budget in the House of Commons on April 16, 2024. The budget proposes more than $52.9 billion in new spending over the next 5 years. This webinar is an important opportunity for the CPAs and accountants to stay updated with the latest tax policy changes. The knowledge shared here is crucial for maintaining compliance and providing the best possible advice to your clients. You will gain a thorough understanding of the key changes in the taxation field, and also you will learn how these changes will impact the businesses and accounting practices in Canada. Today's webinar is designed as a discussion format where our two speakers, Anand Raj Pillai and Abhishek Shah, both chartered accountants, will deliver and bring a wealth of knowledge and practical insights that will be invaluable for all the attendees. Now, let me introduce our speakers. First, we have Anand Raj. With 6 years of experience in Canadian accounting and tax, he has a deep understanding of the intricacies of Canada's tax landscape and has been helpful in guiding businesses through their tax obligations. Next, we have Abhishek, who brings 2 years of experience in the field. Despite being relatively new, he has demonstrated expertise in tax compliance and strategic tax planning. I'm sure that these two guys are very capable enough to take you through all the new changes in the taxation field. We encourage you to actively participate in this session, and also we have a Q&A section at the end of the discussion. Once again, thank you all for being here. Without further ado, let's dive right into our discussion. Anand Raj and Abhishek, the floor is all yours.
Hi everyone. This is Anand Raj, and with me is Abhishek Shah. So we are here to discuss about the federal budget 2024. So Abhishek, what do you think is the biggest change in this year's budget?
Hi everyone, this is Abhishek Shah, and a warm welcome to all of you. I hope you are all having a great day. So the biggest change that we have seen in this year's budget is regarding capital gain inclusion rate. Now there has been a lot of controversies and speculations, and people are having mixed opinions about whether they like it, whether they don't like it, whether it is beneficial for the government, whether it is beneficial for the taxpayers. So we'll include all that and we'll discuss about it. I would like to divide the topic into two parts. One is before 25th June 2024 and one is after that period. Let's talk about first before 25th June 2024. The capital gain inclusion rate before that period is 1/2 of the capital gains earned. Let's take an example. Let's say a taxpayer has earned $600,000 of capital gain in a particular year. So 1/2 of that is $300,000, would be included in their taxable income and would be taxed as per the marginal rates applicable to the taxpayer. This is what the old provision says. Now what the budget has proposed is, after 25th June 2024, I'll again divide the topic into two parts. One is for individuals and one is other taxpayers. Let's talk about other taxpayers first. For all the taxpayers apart from individuals, the inclusion rate has been increased from 1/2 to 2/3. Now what does this mean? As per the example that we have discussed, let's say the taxpayer has earned $600,000 of capital gain. So 2/3 of that part, that is $400,000, would be included in their taxable income and would be taxed as per the marginal rates applicable to them. Now there has been a certain exemption that has been given for the individuals. Regarding the individuals, up to $250,000 would be the inclusion rate would be as per old provision, that is 1/2. After this limit is crossed, then they will be along with the other taxpayers, the inclusion rate would increase from 1/2 to 2/3. So this has been the biggest change that we have seen in this year's budget.
Okay, so I think the smart taxpayers would have already saved taxes by realizing the capital gain before 25th June 24, right?
Definitely, that would be the idea. If they want to save some money on taxes, that is the thing to do.
Yeah, so the key takeaway here would be to retain assets in your personal name, as this allows individual to utilize the 250,000 exemption and achieve significant tax savings there.
Yes, the government has helped the individuals with a certain exemption. So it's advisable that they take this exemption and retain the assets in their personal name.
Okay.
Okay, here is an example that we'll see. The proposed higher inclusion rate on capital gains would result in more equitable marginal tax rates across revenue. Obviously, the inclusion rate has been increased, so the tax rate would also be increased, and this would increase the revenue for the government. The proposal would increase the average federal provincial marginal tax rate on capital gains above $250,000 up to, let's say, someone is earning 1 million in capital gains, so the rate would be around 35.7%, as you can see in the example.
Okay. So Abhishek, can we say that government is trying to focus on middle class section?
No, I don't think so. The government is concentrating on middle class, but the main focus is on the wealthy individuals. What they are aiming is, if you earn more, then you pay tax more. If you talk about individuals, then certain exemption has been given, as we discussed earlier as well, and there are some other benefits as well for the individuals. In addition to the $250,000 that we discussed, the middle class Canadians will continue to benefit from tax-free savings account, the principal residence exemption, and exemption from registered pension plans. So the main idea is for the middle class, and not that they get hampered because of this.
Okay, so this will allow the government to significantly enhance any investment in infrastructure.
Yes, if we see this on the macro level and for the government, then this will increase the revenue of up to $19.4 billion for the government, that is likely to be spent on middle class and increasing the standard of living and affecting the middle class on a majority level in the next 5 years.
Okay, good to know about it. So is there any change, any other change with respect to capital gains?
Yes, this was the biggest change. Apart from that, we have seen another change as well in the lifetime capital gains exemption. So this lifetime capital gain exemption currently allows Canadians to exempt up to $1,016,836 in capital gains tax-free on a sale of a qualified property. Now this limit has been increased to 1.25 million effective from 25th June 2024, and it will be indexed to inflation thereafter. However, there is one important fact that I would like to highlight is the government will maintain the exemption from capital gains from the sale of principal residence of taxpayers. So if any amount that you make from selling your primary residence, it will be tax free. It will not be taxed.
Yeah, so it is good to know that any amount you make when you sell your home will remain tax free.
Yes, definitely. And another point that I would like to highlight here is regarding the lifetime capital gain exemption is it is only applicable to qualified property. Now there are certain property that has been defined as qualified property, and I would just like to brief you on that. What all are included in the qualified property is small business shares, farm properties, and fishing properties. Only these three will be included in qualified property on which you can claim lifetime capital gain exemption.
Okay.
So as you can see, we'll discuss an example on how this works with lifetime capital gain exemption and without it. Let's say the proceeds of disposition is 1 million. The adjusted cost base as per the inflation would be 90,000, and the capital gain would be $910,000. Now, if we take lifetime capital gains exemption, for 50% of the limit would be applied to the entire capital gain, and it will wipe off the capital gain, resulting in taxes payable to zero. Now, if we don't take this exemption, then as you can see, the taxable capital gain would be 50% of $910,000, which is $455,000, and tax rate is very, very high, the marginal tax rate being 53.53%. resulting in taxes payable of around $240,000. So you can see that this is a very big impact on taxes payable, and the exemption is huge.
Okay, so this really brings a tax savings to a great extent, right?
Yes, this has been a great relief for the qualified property owners, so that they save a lot in taxes.
Okay, okay. So, is there anything for entrepreneurs? Because we see entrepreneurship has been rise. Has the government taken any steps to promote it?
Yes, entrepreneurship has been on the rise, and now every other person wants to be an entrepreneur. But the government has done something to support this. To encourage entrepreneurship, the government is proposing the Canadian Entrepreneurs Incentive. Now, this incentive would provide the capital gain inclusion rate to 1/2 of the prevailing rate. Now, currently the prevailing rate is 2/3. So, the government is proposed that this be turned down to 1/2 of the 2/3, being 1/3. And the limit would be up to $2 million earned in capital gain by an individual during their lifetime. So this $2 million limit will be phased and will be divided into 10 years up to 2034. And this measure would apply to dispositions that occur after 31st December 2024. So 24 will not be included. So starting 2025, it will be applicable from that period.
Okay. So I would say it is advisable to take advantage of these tax strategies, incentives to maximize your savings and fuel your entrepreneurial success, right?
Definitely, we as professionals would like to suggest that the taxpayer should adopt these strategies so that it will be beneficial in their financial planning and would minimize their tax burdens in the coming years.
Okay, okay. Great to know about this incentives. Okay, so other than that, I would like to know about short-term rentals. The short-term rental business has been growing rapidly, with many people earning substantial rental income without complying with applicable laws and regulations. So, what the government stance on this issue?
So, real estate and our houses are very close to our heart, and the government believes that homes are for Canadians to live, not like speculative assets that the investors can earn money from. So the short-term rentals currently listed on platforms like Airbnb and VRBO are keeping 19,000 homes off the market. So they want to make some quick money, and that is why the normal people are not able to buy houses because of this. So government has come to the rescue, and they have proposed some changes that will impact this. The changes that would apply as of 1st January 2024 would be to deny income tax deductions on income that is earned from short-term rentals that do not comply with the provincial or municipal laws. So if you are not complying with the government regulations and rules, then you will not be allowed deduction for the expense that you incur. Now, by denying these income tax deductions, the main objective of the government here is remove the profit incentive for the short-term rental operators.
Okay, sounds good, but when the short-term rental can be considered as non-compliant?
Okay, there are two ways in which a short-term rental would be considered non-compliant. One is the province or municipality does not permit the short-term rental operation at the location of the residential property. This is one, and the another would be the short-term rental operation is in non-compliant with the applicable registration, licensing and permit requirements. So these rules and regulations must have to be followed that are prescribed by the government in order for you to claim the expenses and save on taxes. If you are not doing so, then the entire expense will be added back in your income and you will have to pay tax on it. So the main driving force here is to earn money. So this is what it caters to, that it does not allow the short-term rental operators to earn money. That is why this is a big impact on short-term rentals.
Okay. So I think these measures are like designed to prioritize housing for Canadians, ensuring more homes are available for families, students, workers, seniors, while discouraging speculative investments in the housing market.
Definitely, this will handle or restrict the discrimination and manipulation by the people who have the money and who can buy houses and put them on rent. So I think this is a great initiative by the government.
Okay, okay. Okay, so let's move ahead. Let's discuss on the topic that has not seen any significant changes since a long time. Can you brief us about the changes proposed in AMT?
Yes, as Anand Raj said that it is right that the AMT has not been properly revised or significantly changed since 1986, and current year budget has proposed some changes. So it's a little bit technical, so I'll request you to be with me. The first change here is the rate has been increased for AMT. Earlier it was 15%, but now it is 20.5%. And the basic exemption amount has been increased to $173,000 in 2024. It is the top federal tax bracket. Another change that they have proposed is to limit deductibility of certain eligible non-refundable tax credits to 50%. Exceptions definitely apply here. For example, charitable donation tax credit is affected by this change. The budget here proposes to revise the charitable donation tax credit to allow individuals to claim 80%. Earlier it was 50%, but now they have changed it to 80% when calculating AMT. So this is also a huge impact as they have increased the limit. However, these amendments would apply to taxation years that begin after 31st December 2023. So these has been the two major changes that they have proposed in AMT.
Okay, so far we have covered the major changes proposed in the budget. Now let us focus on some smaller yet impactful changes.
Yes, till now we have covered some major changes, but I would like to highlight some of the little changes that are important and impactful. However, they are not that significant. First is Canada Child Benefit. A CCB recipient is no longer eligible to claim CCB, that is Canada Child Benefit, in respect of a child in the month following child's death. Now this period has been extended to 6 months. Earlier, if a child dies, then the CCB recipient would not be eligible to claim the CCB. However, the budget proposes to extend this eligibility for the CCB to 6 months after child's death. So they have increased the period to claim the CCB. That is what they have proposed. Another significant change that I would like to highlight here is regarding the home buyers plan, that is HBP. To help first-time home buyers, the budget proposes that to increase from $35,000 to $60,000 the amount that an eligible home buyer can withdraw from their registered retirement savings plan under the HBP without subject to withdrawal tax. So this is the amount that is not subject to tax if you want to withdraw the amount. To buy or to build qualifying home, so you'll have to buy or build a home in order to claim this, and this will be effective for 2024 and subsequent calendar years. Another change that they have proposed is temporarily extend the repayment grace period. Earlier it was 3 years, now they have changed it to 5 years under the home buyers plan, so that the eligible home buyers who withdraw from their RRSP between 1st June 2022 and December 31st 2025 will have more time period before they need to start repayment. So earlier they had to repay within 3 years, but now it is changed to 5 years. Another significant change that I would like to highlight here is regarding the GST and HST registrations. The government has made it mandatory to file the returns electronically. Now, obviously, the era is paperless and everybody is going electronic to cater to all their needs. So the government has made it mandatory that all the GST and HST returns have to be filed electronically. If you file the paper GST returns on paper, then you will be subject to a penalty of $100, and for the first HST return. So, and if any subsequent return is filed, then the penalty is even more, that is $250 for each subsequent return filed. However, while earlier the CRA have waived these penalties, but now the relief has been gone. So now you will have to follow the rules and file the returns electronically. I wonder, Anand Raj, who would be filing on paper nowadays, since everything is electronic anyways?
Nobody.
Absolutely. Okay, so now till now we have discussed some of the changes that would be affect the individual taxpayers and CPAs. Now I'll share the stage with Anandraj, and he will take over and he will guide us on some of the corporate related benefits that the budget has proposed.
Yes, so there are some benefits and tax credit available for the corporations. So I would like to start with accelerated cost allowances. So the accelerated CCA is available to two assets. So one of the asset is purpose-built rental housing. The budget provides an accelerated CCA of 10% for new eligible purpose-built rental projects that begins the construction after April 2024 and before January 2031. So the eligible properties are the properties that have at least 4 apartment units or 10 private rooms, and at least 90% of residential units are held for long-term rental. So other than that, the accelerated investment incentive, which suspends the half-year rule, will continue to apply to the eligible property put to use before 2020.
So is it applicable for renovations as well?
So here I would say the accelerated CCA will not apply to the renovations of existing residential unit. But if you build new additions to the existing structure, then that new addition will be eligible for the accelerated CCA. Again, if there is any project which converts the non-residential unit into a residential complex, then it will be eligible. So that was about the purpose-built rental housing. So the other asset that we have is productivity enhancing assets. So budget provides immediate expensing for this type of assets. It means you can claim 100% amount in the first year itself. So if the property is acquired after April 2024, then it becomes available for use, that is before January 27, then you can get this benefit. But the only thing is, it is only available for the following 3 classes. The classes are class 44, class 46 and class 50.
Okay, so when can I expense this off? Like, is it in the year of acquisition or is it in the year of available for use? What is it?
Yeah, good question. So the accelerated CCA will be available only in the year the property becomes available for use. Let's say if the year is a short taxation year, then the accelerated CCA must be prorated and it will not be available for the following taxation year. So that's it about this assets in which you get CCA.
Okay, so is there any other benefit related to any technological development? As we have seen, technological development has been on the rise.
Yeah, you are correct. Currently, everyone is focused on technological development. Everyone likes to drive EV. Every person, like, they are not promoting other fuel-driven cars or something. So the government is concerned about it. So they have brought investment tax credits where EV are used. Like, they have brought tax credit if you generate electricity, if you produce EVs. So one of those things that is clean electricity investment tax credit. So 2023 budget proposed it already, that there will be a 15% benefit, 15% ITC will be available. This 2024 budget provides the design and implementation details on how to get those benefits. So the benefit is equal to 15% of the capital cost of eligible property. So it includes any kind of property that generates electricity, that stores electricity, that transmits electricity.
Okay, so the rate was given by the earlier budget, but the design has been given in the current year.
Yeah, correct.
And what would be the eligibility criteria? Like, who all will be eligible for this tax credit?
So the following corporations are eligible: taxable Canadian corporation and pension investment corporations, provincial and territorial crown corporations, corporations owned by municipalities and indigenous communities. So all these corporations are eligible to get this credit. And how they get the credit? So the properties that are used to generate electricity by any source, let's say solar, wind, water, nuclear or geothermal, anything, including the equipments that is used to generate heat, all those properties are included in it. And properties that are used for storage, I would say stationary electric storage equipment used for pumping hydroelectric energy, any other natural gas energy system. So all those things are covered. Other than that, any equipment used for transmission of electricity between province and territories. So all those things are covered in it.
Okay, so since we are talking about equipments and furnitures and big machinery, so I'm assuming that something has to be proposed for the labor as well, because they'll not run by themselves. Like, they have to be run by the manpower. I've heard something about labor requirements. So can you brief us on that?
So labor requirements is a detailed thing. The government has already proposed the labor requirement laws. So every corporation should compulsory follow those requirements. Those requirements should be met. Then and only then they will get this 15% ITC. If the corporation fails to meet those conditions, then they will get only 5% ITC. So government is sure about it. They must meet these requirements to qualify for the higher deductions.
Got it. Okay. So
And
this was for producing electricity.
yeah.
So is there anything for producing EV, since the government is focused more on converting the combustion engines into EVs, and EVs are not fun though, but it's beneficial for the environment, so we have to do what we have to do.
Yeah, so there is one other investment tax credit with focus on EV producing. So that is EV supply chain investment tax credit. So here the budget introduces EV supply chain ITC that is equal to 10% of cost of building used in Canada. And in the following electric vehicle segment, they can get this ITC. So the segments are electric vehicle assembly section, electric vehicle battery production segment, cathode active material production. So in these three segments, the ITC equal to 10% of the cost of building will be available. So to qualify for this, the taxpayer must claim clean technology manufacturing ITC in all of the three segments. And the ITC is effective for the property that is acquired and become available for use after December 2023. And this ITC will be reduced to 5% at 2033, and after 2034 there will not be any ITCs, it will be zero.
Okay, got it. So these were the credits and incentives for producing electricity and producing EV.
Yeah.
These were quite technical topics, but you simplified it beautifully. Are there any other tax credit that is available, that has been proposed by the budget?
Yeah, there is one more tax credit, I would say. It is a kind of rebate. So Canada carbon rebate for small businesses. So the budget introduced Canada carbon rebate for business to return a portion of federal backstop pollution pricing fuel charge proceeds from a province. So this will be automatic refundable tax credit for CCPC with less than 500 employees in in a calendar year, I would say. So in which the fuel charge begins. The tax credit in respect of 2019 to 2024 fuel charge years will be available to CCPC that files the return for 2023 taxation year by July 2024. So that is the date. You should file your tax return before that date, then you will be eligible. Okay, and there is some provision to determine the tax credit amount. So how it is determined? The tax credit is determined for each applicable province in which the eligible corporation had employees in the calendar year in which the fuel charge year begins, and it is equal to the number of person employed by the eligible corporation in the province in that year multiplied by a payment rate specified by the Minister of Finance for the province for the corresponding fuel charge year.
Okay, got it. So these were very helpful benefits, and I'm assuming that all the businesses or corporations that are engaged in these kind of fields, it will be significant amount of tax credit that the government has proposed. So are there any precautionary measures or preventive measures that the corporations should be aware of, or they need to take care of, or something like that?
Yeah, I understood your point. So there are some things that budget has brought that you need to be take care of. So those things are I'll be covering it now. So one of the point is taxing vacant lands to incentivize construction. So the government is concerned that some landowners are holding residentially zoned vacant land as a speculative investment. The budget announces that government will consider introducing a new tax on residentially zoned vacant land to spur the development. The government will launch consultation later this year. Other than that, there is one another point that is confronting the finalization of housing. The budget announces that the government has an intention to restrict the acquisition of existing single family homes by very large corporate investors. The government will again consult in coming months and provide further details on it. And other than that, there is one important point that every corporation should be aware of, that is non-compliance with information request. So the budget proposes several amendments to CRS information gathering provisions in the Income Tax Act with the intent of enhancing the efficiency and effectiveness of tax audits and facilitating the collection of tax revenue on a timely basis. So these changes give some powers to CRA. I'm going to discuss about those powers now. So it allows the CRA to issue a new type of notice. It is known as notice of non-compliance, and by that CRA can levy a monetary penalty on the corporations. It also permits CRA to specify that any required information or document can be provided under oath or affirmation. And it also empowers CRA to impose a penalty when they obtain a compliance order against the taxpayer. Other than that, there is one more thing, that is extending the stop the clock rules, which suspend the counting of days in assessment limitation period, so that this rule apply when a taxpayer seeks judicial review of any requirement or notice issued to the taxpayer by CRA in relation to audit and enforcement process, and during any period that any notice of non-compliance is outstanding.
So since we work in this field, we know that the CRA notices can create anxiety in taxpayers. So this is a very good point of notice of non-compliance that you highlighted here, so that the taxpayer should take care of this.
Yes, definitely. They should be aware of these points. Otherwise, someday CRA will come and we will be unaware of these things. So we'll be at trouble. So it's better you be aware of everything.
Definitely.
So similarly, one more point is there, that is avoidance of tax debts. So many times we see that the taxpayers are trying to avoid their tax liabilities. So it is tax evasion, which is not permitted. If you are planning in a legal way, it is a healthy thing. It is permitted, but tax evasion is not permitted. The Income Tax Act includes an anti-avoidance rule that is intended to prevent taxpayer from avoiding payment of their tax liability by transferring their asset to any non-arm's length person. So the effect of this tax debt avoidance rule is to make the transferee jointly, severally and solidarily liable with the transferor for the transferor's debt to the extent the value of property transferred exceeds the amount of consideration given by the transferee for the property. So it's clear that you will be held liable if you do some transfer in an illegal way. So the ITA also contains number of rules that address various planning techniques employed by taxpayers attempting to circumvent the tax debt avoidance rule. So as well as penalty for those who engage or participate in this kind of practices. So in many cases, what happens? Tax debt avoidance planning is facilitated by some planner, somebody like who knows loopholes of this tax provisions. So what happens? The planners charge some significant fees, and by charging that fees, they create a plan by which the tax is avoided. So the court have held such taxpayers who engage in tax avoidance planning as liable for the penalties. So this budget proposes the taxpayer who participate in tax debt avoidance planning will be jointly, severally and solidarily liable for the full amount. That is including any portion that this kind of planners have retained with them as a fee. So that fee is also included in the liability. And
So
one
it's
more thing,
advised. It is advised to plan rather than evade, as we
yeah,
discussed the
correct,
consequences of tax evasion,
correct.
and you
So
don't
there
want to
is
be
a thin
the
difference between
pro-
planning and evasion. So the every
definitely.
taxpayer should be aware of.
Great, great.
So one more thing that is every taxpayer should be aware of is reportable and notifiable transaction penalty. So what happens when we see the Income Tax Act? There are some general rules and there are some specific rules. So general rule says that the person who fails to make return or person who needs to comply with certain specified filing requirements is guilty of an offense and liable to penalty up to $25,000 and imprisonment for 1 year. So that is the general rule. But there are some mandatory disclosure rules also there in ITA, that is Income Tax Act. So those include specific penalties that is applicable in certain circumstances. So now there is some overriding between the general and specific rules. So budget says that it will remove the general applicability. General rule will not be applicable on these cases. That is reportable or notifiable transaction under the mandatory disclosure rule. So that rule is now specific, and the general penalty will not be available on it.
Okay, $25,000 in penalty, like it's huge. You bury a
Yeah.
hole in your pocket.
Yeah. So that's it from our sides. We have covered so many things that we think in the budget are necessary to understand. So I would like to ask our director to speak up.
Thank you, Abhishek and Anandraj. This was a very insightful presentation, and thank you for sharing your expertise. Your analysis and strategies have provided us with the valuable knowledge to navigate these changes effectively. If anyone has any questions, I would like to request you to drop it in the chat box, and we'll get back to you soon as possible. Please feel free to just drop in any questions, even personally, or if you want us, you can later on email it to us or anything. Like, everybody has my LinkedIn account access also, so you can just drop in a message over there also. And thank you all for your participation throughout the session. We hope that you found the webinar informative and beneficial for your professional development. Also, I would just like to shed some light on my company. NCS Canada offers comprehensive outsourcing solutions for all your accounting and taxation needs. Our team of experts is here to help you save time and resources by outsourcing your accounting tasks to us. We handle everything from bookkeeping and financial reporting to tax preparation and payroll management. We allow you to focus on the main part of your business, and that is business development. If you have any other further questions or need additional information, please feel free to reach out to me. Also, once again, thank you for joining us today. We appreciate your time and we look forward to seeing you at our future webinars. Thank you and have a great day.